Welcome back to the Elias Macko Show. It's the third hour of the program. Now, after raising interest rates just over a month ago, the Bank of Canada is rumored to raise it again tomorrow. Economic forecasters say that the economy is not softened enough for the central bank to back off and must continue hiking interest rates if they want to reach their target of an inflation rise of only 2%. As a rumored recession has been going on since the end of last year, some economists say that raising the interest rates may actually be helping the economy, and more hikes should be expected in the near future. Let's take a look at this. Randall Bartlett joins us on the line, Senior Director of Canadian Economics with Desjardins. Randall, welcome to the program.
Great to be here. Thanks so much for having me.
First things first, I just want to talk about how you would describe this economy, because to me, it just seems like it seems weird. You know, like everyone keeps saying recession is coming. Employment rates are still very, very low. So people are working. And yet I see a report that says so many Canadians are $200 away from not being able to pay their bills. It just seems so weird. How would you describe it? Because I think you're a little bit more qualified than some radio host.
Well, I mean, to be fair, though, I would say that weird is probably the best way to describe it. I think you mentioned before that economists have been expecting a recession now since the beginning of the year, and we were in that same boat last year as well. That was our forecast. Given how quickly interest rates are rising and to the level that interest rates are rising, we hadn't seen them rise to the level they're at now since for about 20 years. So it's certainly not what one would anticipate in terms of what's going on in the economy, given how high interest rates are. But to your point, it is a strange sort of set of circumstances that we find ourselves in. We're seeing now that Canada is experiencing record population growth, and that's continuing to help drive economic activity despite the higher interest rates and inflation that we have. We're also seeing that the labor market is very, very tight. A big part of that is we came up against a long-term demographic trend of an aging population when the pandemic happened. And so ultimately, people have left the labor force. And so there's a lot of demand for labor out there. And so we're seeing a lot of population growth supporting, because of this demand for labor, but that's ultimately keeping the economy ticking along. We're also seeing that Canadians have a lot of savings, a lot of pent-up savings. And so even when we compare it to other countries, Canadians have a lot of cash in the bank compared to other countries. Now, that's helping to support the Canadian economy, but at the same time, it's not evenly distributed throughout the Canadian economy, to your point. And so a lot of that is held. I mean, we have to look to U.S. data to get a better indication because the data here is not great in Canada on this kind of thing, but it's really sort of concentrated in the upper half of the income distribution. And so certainly there are a lot of forces that are really starting to, really supporting the Canadian economy in spite of the higher costs and the higher interest rates that we're seeing right now.
So we're expecting a rate hike tomorrow. What are the risks? What are the risks if we increase interest rates to a level where, some homeowners face more stress, home buyers face additional stress? What are the risks to these continued interest rate hikes?
Well, these interest rate hikes that we're seeing, so the one we saw in June was 25 basis points. We're expecting another 25 basis point hike tomorrow. And so they're relatively small. I think the problem you're getting in terms of change, but the level is high. That means tomorrow the overnight rate or the very short-term interest rate could go up to 5%. And so that means that prime rates are going to be even higher. Mortgage rates are going to move even that much higher. And so as households renew their mortgages, they're coming up against this much higher cost. And that's why interest rates, you don't feel the full effect on the economy right away. It does take time. It takes, up to a year and a half or 2 years before any increase in interest rates are fully felt in the economy. And so households are continuously, more and more households are continuously feeling the impact of these higher interest rates. But the one thing that's really uncharacteristic about what we're seeing now compared to past cycles where the Bank of Canada hiked interest rates is that there are some households, and not an insignificant portion, a small portion, but not insignificant, that have variable rate fixed payment mortgages, that instead of passing along the full increase in interest rates onto those folks, some financial institutions have allowed them to instead just pack that higher payment that higher portion of their monthly payment against their principal. So to actually increase the amount of outstanding principal that they have. And so consequently, their amortizations have been extended, and those folks ultimately are going to feel the impact of higher interest rates. It's just going to be more in 2025 and 2026 than in 2023 and 2024. And so we're going to be feeling the impact of these higher rates for quite a while to come. It's not just going to be a short-term impact. We're going to be feeling it down the road too.
So we're with Randall Bartlett, Senior Director of Canadian Economics over at Desjardins. So Randall, let's talk about inflation right now and what's fueling it. It's not lost on me, the Canadian government just delivered its quote-unquote grocery store rebate, and that put a lot of money into 11 million Canadians' bank accounts. Here in Quebec, as of July 1st, we've got lower income taxes, and Quebecers are now seeing a little bit more on their paychecks because of that income tax cut. So let's just talk about the money that governments are throwing at citizens still we're removed from a pandemic, and if that is at least in part fueling inflation.
Yeah, absolutely. I mean, there's no doubt that when, governments cut taxes or increase spending, those things are inflationary. When they're targeted towards, people who are the most vulnerable in society, in that case, they do tend to get spent fairly quickly because they're going toward, generally sort of necessities. But we think, the amounts that are going to households, particularly the federal transfer, they're well targeted, they're relatively modest. So we're not expecting those to have a meaningful inflationary impact. There are some parts of the country that just have sort of broad-based stimulus measures that are going out. Think of places like Quebec, but also outside of Quebec, places like Saskatchewan and Alberta and that sort of thing. And so we've seen some of these broad-based measures, and those are, while they're not necessarily boosting inflation by a huge amount, they're preventing inflation from coming back down. You know what I mean? They're preventing that return to 2%, which is ultimately keeping inflation, interest rates higher than they otherwise would be. But I think the interesting thing too is what we're seeing as we sort of unpack inflation more broadly, and really one of the biggest contributors to inflation that we're seeing right now at the national level is on the shelter side of things. And so we're seeing that housing costs are feeding into inflation consistently, because when you think about where home prices are now relative to before the pandemic, sure, they've come down from the peak, but they're still well above where they started the pandemic. And so we're still seeing gradually housing costs sneaking into inflation. We're seeing that mortgage interest costs, now one of the biggest drivers of headline inflation. We're seeing that rents are coming up considerably. And so all of these are big drivers of what we're seeing in terms of overall headline inflation. But even when you remove the shelter piece out, inflation's still broad-based. Inflation we're still seeing, higher levels than that are consistent with the Bank of Canada's 2% target in a broad number of categories. And so we're still seeing this overall stickiness in inflation, even when you remove some of those more volatile factors out of it. So
is there a limit to interest rate hikes? I mean, how high can it go?
Well, I mean, that's a good question, right? We haven't seen, interest rates at this level since the early part of this century, and we haven't seen inflation at this level, or at the level maybe it was at when it hit its peak back in the summer of 2022. And we hadn't seen inflation at that level since Hall & Oates Maneater was topping the charts back in 1981. And so it's one of those things where it's these are levels that we haven't dealt with this sort of situation since really the early 1980s, or even maybe into the 1990s. And so this is unprecedented in a generation. But to be fair, this is sort of what monetary policy and then what the Bank of Canada does has sort of developed in this context. And so we could see interest rates move higher. We think there'll be that hike tomorrow. Certainly it's going to move higher tomorrow, but we think the Bank of Canada will keep the door open to future hikes, because until inflation starts to meaningfully cooperate and we start getting a broad-based slowing in inflation that's moving consistently in the right direction toward the Bank of Canada's 2% target, it's going to have to keep rates more elevated than I think it'd be comfortable with, just in order to make sure that it meets its mandate to have low, stable, predictable inflation in Canada.
Randall, plus 1 point for the Hall & Oates Maneater reference, and we got to leave it there. Thanks so much for coming on.
My pleasure. Thanks so much for having me.
That's Randall Bartlett, Senior Director of Canadian Economics over at Desjardins.